Hello, everybody. This is Paul Hitchcock. Welcome to Wealth Protector TV. And this is our channel at the firm Barth Calderon. We go live every Thursday, 1 p.m. California time to bring value to you, keep you alerted to hot topics. Really excited to have my colleague, James Nguyen, here with us today. Welcome, James.
Thank you. Thank you.
Yeah. And so this is a very hot topic. We're going to jump right into this. And I want to say before, James, we tee it up that for all those listening here, there is a way to get one on one with James. If you have any questions that come up after watching this, if you see on the screen there, if you text guard assets to that phone number, you'll get a chance to pick a time on the calendar to get one on one. It's complimentary to answer any and all questions you may have going on. So, the topic we're jumping in today is James, there's a ton coming out of Washington on changes to the tax code, which affect estate and asset protection planning. So, I know you're going to give us a quick update on that. And then we're going to get into some of the strategies that you and I were just talking about offline, gifting strategies that you and the rest of the team are very busy on right now, helping clients with to lock in laws that exist now that are changing in the new year. So, James, with that, you want to jump in? What's coming out of Washington? What's going on?
Absolutely. So right now, with the new tax bill that they're trying to get through the Congress and Senate, is they're trying to reduce the state tax exemption and gift tax exemption. So essentially, what that means is when you're trying to gift assets to anybody, whether it's family members such as kids or friends or family, the government wants to take a piece of that gift. They want to take 40% of that gift. But
Doesn't matter what it is, James. A business, stocks,
doesn't
bonds,
matter
and
what it
cash,
is.
property, whatever.
Right, right. Business, properties, cash, anything. If it comes off of your balance sheet and it goes into somebody else's balance sheet, they want a piece of that pie, whether it's during your lifetime or when you pass away. So that's all inclusive in this. So they want 40% unless we fall under certain exceptions. And the big exception that we're taking a look at is under today's law, 2021, you have an exemption of $11.7 million. So you can give $11.7 million to whomever you want during your lifetime
Is that per person?
per person. So with
Okay.
couples, it's $23 million and change.
So that's a
Right.
lot of money. It's a lot of
It is a
money.
lot of money. Now, in the beginning of this year, Washington was trying to reduce that from $11.7 million to $3.7 million per person, which is a gigantic change.
Massive.
Um, Massive, yeah. And there's been pushback. And so they're still compromising. So we don't know what's going to come out of Washington, but it looks like they're going to reduce it from $11.7 million to about $6 million roughly per person,
Per
which is
person,
still cuts the exemption in half.
right?
Um, so that means between married couples, that's about $12 million. So if you have assets of above $12 million and you want to give it to your kids or whomever you want, um, government wants 40% of that.
40. Now, are they raising the 40% mark too, or is that staying the
That
same?
was discussed. Originally, they wanted to raise it to 45%, slated up to 65%. But because of all the pushbacks, looks like they're going to compromise that and keep it at the 40% limit. So,
40%. But we'll find out for sure, right? Because it's not
correct.
passed yet. Yeah, coming out.
Right, right. This is
Yeah.
just what's on paper so far. Nothing's passed yet. So yeah, we have that the limited window in 2021 this year to gift. If you're planning on gifting more than $12 million to the kids, between 12 million to $23 million, now is the time to do it to save the kids 40% on that difference. So that can be up to $4 million if you make that gift today.
Today. So it's a big savings. And um, as you're doing that, James, I mean, even if the law changes in 2022, you can lock in existing laws, and it's you're not going to.
Exactly.
Yeah.
So earlier this year, the IRS had given us their blessing that they won't claw back any excess gifting we've done if they do lower the exemption. So
Okay.
it's perfect time to make that gift if you can, and if it makes sense in um, the clients and the kids' eyes.
Right. Yeah. And again, this comes into play with people who own a business, because you're talking, I mean, not a lot of people have 12 million bucks sitting around in cash, right, in the bank account. But if you have a business, properties, we have a lot of clients that have rental income properties. I mean, that's where you start getting into the scenario of
Absolutely.
bigger state. Yeah.
Yeah,
Right.
and when you deal with businesses, there's more complexities because you have to deal with valuations, and it's not easy to value businesses. And you can get discounts on that valuation under today's laws, which that might be going away as well under the new tax changes.
Yeah, that's a big deal, right? The discounting and
Absolutely.
and it going away. Yeah. Can you just expand on that just for
Sure.
a second? What is that about, the discounting thing?
Sure. So if you own, let's say, 100% of the business and you gift a smaller portion of that business to the kids, let's say 40%, even 50% of it to the kids, you're gifting a minority interest of the business to the kids, which is worth a lot less than 100%. There's also other discounts that can be taken, which is if kids don't become the managers of the business, they don't have managerial control. If the kids, they can't automatically sell the business to any other person. So we have a lack of liquidity, a lack of marketability. You can't use 1% of a business to, buy a token for the subway. So you can't do much with the business
Right.
um, just because you own it. And there's a couple other smaller discounts as well, but essentially all those discounts combined can get you anywhere between a 30% write off of the gift that you gave to the kids
Oh,
because
okay. So it's big.
it's a big chunk. Absolutely.
And they're looking to take that away.
Yeah. So they're trying to take that away from inter-family gifting. So if it's you gifting to your kids, even though those discounts do exist, the IRS won't recognize it, so they won't allow you to take it anymore. That's what they're trying to do,
Right.
and that might go through.
Okay. It's unreal, right? Which I've heard you talk about, that the unintended consequence of that is people aren't going to sell their businesses,
Oh,
right?
absolutely
I
right.
mean, it's gonna put a halt on commerce, which is the reverse of what they're trying to do, is collect more money.
Well, the goal of these taxes is to break down the wealth from the people who has it and try to redistribute it out to the other folks.
Right.
Um, so that's the goal, and that's why they're trying to. That's why they try to collect so much from the state taxes. It used to be the original reason for the estate and gift tax, that 40% was to fund the Spanish American War, which
Is
is
that right?
yeah, that's long past, and now they just use it as a tool just to try to equalize the wealth.
Yeah, reminds me of the tolls that they charge on the Golden Gate Bridge. The original reason was to pay for the bridge. They paid for it many years ago. That toll keeps going up. It's not it's not
Right.
gone. Oh man.
Yeah.
Okay, so very, very interesting. So let's get into the gifting, James.
Oh,
And
sure.
yeah, what are you doing with gifting, and what's going on with that whole scenario now?
Right. So a lot of the times we're talking with clients to see, does gifting make sense. Um, for many clients, it doesn't make sense. For many of them, it does. There's a lot of complications with businesses. Right? We mentioned a couple of them with real property. If you're gifting assets such as California property, there could be issues with reassessments because California recently passed that Prop 19 law
Right.
earlier this year, and
Horrible.
exactly. Now, if you gift non-primary residence to kids, they get reassessed on it, and so there's a couple workarounds, potential workarounds around that, but it's a bit too late in the game to safely utilize those. So there's a risk involved with utilizing that. There are, yeah, so there's complexities for all the gifting situations. We utilize certain trusts to help offset some complexities, such as if people wants to maintain control over their company, even though they want to make gifts to the kids, we can do that.
So that involves somebody who's gifting shares of their company, privately held company, to
Mhm.
the next generation, and they want to maintain control,
Right.
even though it's a minority ownership, James. I mean, the kid wouldn't have control of the business, right, with a minority stake.
They wouldn't have direct control, and sometimes they do want to give more than a minority interest. Maybe they
Oh,
want to
okay.
give 100% of the business or 80% of the business, but still maintain control. We can still do that to them, well, for them, but we have to utilize some different mechanisms such as special trust, gifting trust, um, to accomplish that.
Okay. What
Yeah.
and as you're getting into the gifting strategies, uh, are you doing, like, is there an upfront analysis that you're doing, or how do you determine if it's appropriate for people to use the gifting strategies?
Right. So there is an upfront analysis. We want to see what they want to do first, and then we can see if we can craft a plan to make their dreams come true, so to speak.
Right, right.
Right.
What if the laws, like when the laws change next year,
Yeah.
um, I mean, are there still going to be strategies to get around this transfer tax, or what will happen?
So the laws that they're going to impose, it does hamper our abilities to do a lot of the strategies. So we have to utilize other strategies. So, for example, they've kicked around this exemption amount um, throughout the years. It's
Right.
gone up, it's gone down. There's threats of it going down. There's threats of it of increasing the rates, and um, those were always just number changes. Changing the exemption from 12 million to 5 million, or um, whatever the numbers were. But during this change of tax laws, they're trying to take away some of the tools that we use to um, help the clients move assets from one generation to the other.
Right.
So the use of Grantor Trust, or which affects a number of tools that we have, and
What's a grantor trust?
it's basically a trust that um, fancy trust that allows the person who created the trust to be responsible for the taxes. Um, so if parents created a grantor trust, even though the assets goes to the kids, the income taxes or the capital gains can still be paid by the parent, which is pretty cool because it burns down the parent's estate while still increasing the kids' assets.
Oh, I see. So it reduces the value of the parents' estate, who have got a big estate,
Right,
for tax purposes. Kids get the assets, but the kids don't want to be, burdened with paying the taxes on it, right? So
right. So
the
an
parents can step in.
example would be, let's say we have $1 million in a gifting trust for the kids, and that $1 million through investments made, you know, $300,000, um, and so now they have to pay taxes on that $300,000. Let's say it's $150,000 of taxes from that $300,000 of of gains. All right. So a grantor trust basically allows the parents or whoever created the trust to pay the $150,000 on behalf of the kids to the IRS, and that's not considered a gift for whatever reason. The IRS allows that to happen,
Oh, okay.
which means that the trust that the kid has gets to keep $1.3 million, and that parent's estate that would have it gets burned down by
Right.
$150,000, meaning that $150,000 is not subject to that 40% gift tax if parents pass away. So
Oh, okay.
pretty interesting. Seems counterintuitive, but it works if you have a large enough estate.
Yeah, and I know we've done a lot of work there.
Yeah.
What do you recommend to people? Is first step is sort of a discovery session. We'll go in there and take a look at what they have, and what how does that work?
Sure. So we take a look at their assets to see first, is there enough assets where it makes sense to gift things to the kids? There's some families out there that wants to say we don't want to give the government any money, and they might be within that threshold of between $12 million of net worth to the $23 million of net worth, and they say let's just give it all to the kids, and the kids in turn agree to take care of the parents. They say, you know what, because you're saving us the 40% tax that we would have had to pay if you passed away, we'll take care of you guys for the rest of your life using that money. And if you run out, then the help with more. So
Right, right.
that's the more complicated situations because there's a trust, not legal trust, but just a
Trust between family members.
informal trust between
Yeah,
families. Right.
yeah, yeah. Um, and uh, do primary residence, James? So you have a big house, expensive house. How does that factor into this whole equation?
Right. So similarly, like I said before, the properties get a little bit complicated because if you give it to the kids, you have to see whether or not there's any other tax consequences, such as do we get reassessed on the property? Whether the parent-child exclusion applies in California, other states they don't have that issue because it gets reassessed every few years.
Right.
Um, and there could be a potential loss of the basis um, or the step up in basis that a kid would get if they inherit the property instead of just um, being gifted the property. So we have to do an analysis there as well to see if the kids wants to keep the property for the rest of their life or if they plan on selling it. Um, there's a lot to go over. It's a complicated
Right.
field or
Yeah.
analysis.
Nothing we're going to solve here on this call
Right.
right now.
Right.
James, this is great information. It's a great little intro to what's going on. And again, I know you and the team are just buried helping people right now. So appreciate you coming on. And I want to say to everybody listening, again, if you have questions or maybe you're an advisor to others who are in this category of needing to really understand what's going on, happy to offer a complimentary assessment to everybody. There's the way to do that on the screen. Text guard assets to that phone number, and you'll be able to pick a time to get with us. James, thank you. I know we're going to have you back on, and we're going to keep everybody updated. So really appreciate you coming here.
Thank you, Paul. It's great talking to you.
Okay, we'll see you soon.